Yeah, I think it's neither here nor there in the sense that a lot of suppliers and a lot of buyers are right now trying to figure out, are we moving out of a recession? Are we going to a recession? I think everybody's looking at the interest hike in the US. That's probably getting one more. At the same time, everybody's thinking, was Silicon Valley Bank the sign that it's over? So it's extremely hard to predict. And if you're a purchaser, it's extremely hard to predict. So you're not going to overcommit. And you're also not gonna cut too low, and we're seeing that in global supply chains everywhere. We are 7 points down, probably the lowest point in 2 years post lockdown. Eurozone even harder, and UK even further down. So extremely hard to predict the current environment. We're not out of the woods, and on the other hand, it's not clear cut that we are seeing a recession. We're seeing a little bit of uptick in the US, but not a lot, and that's on the order side.
As we take a look just at the retailers, it feels as though they've been scarred on both sides, had too much inventory at one point so they couldn't shift the inventory. On the other side, didn't have enough inventory and therefore missed out on some potential sales. Does that mean that they're sort of jumping at shadows on both sides? Yeah,
we've had this nasty bullwhip, right, where during COVID, we saw consumers ordering massive amounts just as a lot of manufacturers was amping down manufacturing levels and sending people home. That spiked prices and had an inventory, big inventory shortage. And then as manufacturers amped up the inventory, we saw consumers going the other way, right? And I think a lot of what we call inflation today is supply side driven inflation. I think we haven't ever really had to deal with that. Most cases of global inflation has always been demand side. And I think some of the tools we're using, such as interest rate hikes, actually worsens it in some parts of the supply chain. So that's one of the big challenges. We don't really know how to deal with this issue.
Are Chinese factories actually up and running at this point? Because the data we've had so far would suggest actually they've suffered from a lack of orders over recent quarters.
I mean, China is open again, and Xi has been very clear, right? It's back to business in China. I think the problem China has is actually not just about China being open again. At the time where China is open, the world has done two things, right? There's global inflation and pushing on supply, consumer demand on one dimension. And then the second thing is, I think after Ukraine, after Russia, there is a nervousness, and there's a nervousness around China. And that also means we've seen diversification continuously the last 4 or 5 quarters. Vietnam, 5 times normal activity. Mexico, 6 times normal activity. So large global supply chains keep investing in alternatives to China. And then you also have that consumer demand issue that China really are dependent on for the high margin stuff that they do.
What's happening with your business? I mean, are you seeing any premium for some of the reconnecting of these supply chains, or are you still raising money? I mean, tell us a bit more about how it's affecting you.
Yeah, I mean, it's funny to see, right? A lot of the companies we talked with over like 6-7 years who said, look, we don't need to do any changes to our supply chain. Everything is working fine. They've been coming back over the last 2 years and say, actually, we might want to be looking at digitizing our supply chains in ways we weren't before. And it's all about today being agile, having resilient supply chains, and that's something we've been selling for the last 10 years. I think if you look at our business, we are well on the way to being profitable and have been on that journey for the last 3 years. So we did not get caught out in I would say, the tech market last year, luckily, and we're just going to continue working on that.
The aim of the central banks appears to be to let the market do part of their job for them in reducing liquidity from the economy and as such not inducing a recession but a slowdown. That's their stated aim now and hope as well. You are talking about this in real terms, saying in the short term you do see a liquidity gap opening up that will hit supplier cash reserves as well. Now, whilst I'll take on board what you're saying in the short term, you think over the longer term this might just pass through, but why won't it stay as tight for a longer term given the fact that rates aren't pivoting anytime soon?
Yeah, I mean, I think first off, orders is the indicator in what will happen in 6-9 months to now, right? Purchase orders coming in today will turn into invoices and then real money in the economy in 6 to 9 months from now. And they are starting to tick up a little bit in the US. Elsewhere, they're not. So I think that's probably my view in the US is we're going to get through it.
But just on that, why would they be ticking up in the US when they actually probably what the Fed is trying to do is to get it to tick down?
That's interesting. I think the way you got to think is that they are essentially ordering to being post the inflation and flattening of the interest. So that's a little bit counterintuitive. But the bigger problem you have is we've been implementing these resilient supply chains. Let's just be clear what that means. That means we ask the suppliers to double their inventory. We're not going to pay for it. And by the way, we're going to pay you later. And then on top of that, as a supplier, you're now paying much more for financing your inventory and financing
So we're not going to give them the orders. We're going to make them have a higher inventory, and they're going to pay more for it. That doesn't sound very fair.
No, and I think then if you start thinking about a lot of the inflation problems we have being supply side driven, putting a lot of suppliers at risk at higher financing is probably not the right medicine to get rid of supply side inflation.